Welcome back to Market on Close. Let's bring in our next guest. That's going to be Matt Collins, head of ETFs at PGIM Investments. Welcome to the show, Matt.
Thank you. Glad to be here.
I wanted to get your overall take here on the market, the volatility, the moves we've seen, the headline risks. We're down this week, not surprising, and investors getting concerned here a little bit. Give me your take here on the outlook for equities.
I'm watching your show prior to joining. I'm watching the countdown clock. I think it's the most nerve-wracking time to join your show, right? You don't know what kind of tornado you're walking into on this show. Luckily, I think we're in a relatively calm day, but that doesn't mean, I think, anything to investors today, right? Volatility is absolutely the name of the game, and investors are doing two things. They're scrambling for safety in the short term, but I think the most important thing that they're focused on now is what's next, right? And the what next is, I think, where the most challenging thing for RIAs to consider. But we're seeing a lot of interest in the market go to AAA CLOs.
Yeah, when you take a look at those, the CLOs that you're talking about, collateralized loan obligations, they're below investment grade, but I like the fact that you mentioned AAA because I think that calms investor nerves. I mean, the performance of PAAA, the ticker symbol there, is done really well. But, people are searching out a little bit of safety here at this point, Matt, and maybe they should be, right?
Yeah, so CLOs get lumped into the acronym world, right? Yeah. Which has that 2008 vibe to it. And some instruments in the market learn from mistakes and some don't. For CLOs, they learned from 2008 and on. And what the most critical component of CLOs that's different than I would think most people consider is there are different tranches to each CLO. So you can invest very specifically to credit quality. So you can only invest in the AAA segment of a CLO, a collateralized loan obligation. That is a game changer, and we can get into some of the details. But as you look at the risk, it drops off substantially once you get below AAA, and that's what people remember from 2008. Mm-hmm. So now that you can sort of carve it up, that's a game changer for investors.
Yeah, when you look at the maybe the return on these type of products, especially the one that you're going to discuss here, PAAA, you look at that and people are looking for safety. People are looking for some type of return. They want to get out of maybe some riskier assets at this point. And that might be for the near term. It might be for the medium term, maybe the long term. But this is maybe one of those areas that you feel is what investors should be looking at, even when times are good also, because it does give you that little bit of a safety play, right?
Yeah, that's exactly right. And if you step back and look at the avalanche of flows going to active ETFs, which is now pretty much $1 trillion industry on, we're right on the border, depending on the day of the week and the markets. You might think when you think active, well, that's all going to large equity, right?
Right.
One of the best-selling asset classes is AAA CLOs. And it's not that investors have finally said, oh, that works now, it didn't work then. AAA CLO ETFs were not available 2 years ago, essentially. Mm-hmm. And you are seeing about 30 billion of flows go into AAA CLOs over the last few years. And you might say to yourself, did something change? This is a $1.3 trillion industry, the CLO market. But it was only insurance companies and asset managers and banks that had access. So bring in the ETF vehicle. Now individual investors, RIAs, can access AAA CLOs. And to your point, they're looking at the return stream. It has one of the most attractive Sharpe ratios, right? Return for level of risk in the market. And it's almost eye-popping. It's almost as steady as you go, but you get great yield.
Yeah, when you talk about that, the fixed income investments of similar credit quality, what are you guys talking here as opposed to maybe just going into the bond market or maybe a savings account? There's some decent yields out there. I'm just socking your money away at this point, near 4%. What type of comparison do we have there?
So let's start with yield, and then I'll touch on returns because you absolutely have to factor in risk. Historically, the hunt for yield is timeless. I don't care if rates are 0 or 5%. Everyone is searching for incremental yield over risk-free. And AAA CLOs, on average, offer about 150 basis points over risk-free. Typically, to get risk-free, or excuse me, yield at that level, you have to add on a lot of risk, and that's made people uncomfortable. So if you step back and say, okay, what's the risk of this category? I'll give you some, at least from my view, some pretty eye-popping stats. AAA CLOs, the max 12-month drawdown over the last 12 years is 1.6%. The broad bond market max drawdown is nearly 16%. Right? So you talk about rush to safety, bonds that fly into the conversation. And that's absolutely a core part of the sort of this rush to safety. But there's risk there, right? So as you hunt for yield, you're getting an equivalent yield of the broad market or investment grade corporates, as an example, but you're getting substantially less risk.
Yeah, and Matt, when you talk to an investor, you talked about the short lifespan so far of these AAA-rated CLOs. Give our viewers, give investors out there some type of comparison where, hey, somebody might have gone into this product 5 years ago, but now look at this other product using your ticker symbol PAAA as an example. That would be a good comparison where they could maybe offset some of the risks or allocate a substantial amount to a position like this.
Yeah, so it's going to be very dependent on the bucket you put this in. But let me be very clear. This is a timeless investment, because it is offering incremental yields, but it's not necessarily meant to replace your bond investment at all, right? Because you will not get the return from the switch in the rate environment. To the extent rates drop, you're not going to have an enormous amount of capital appreciation on a floating rate, no duration, a limited duration, I should say, product. You're just not going to get it, but you're going to get the same level of yield from riskier asset classes. So the way we look at it is cash plus plus, right? This is your cash plus plus. It's your stable as it goes. You're going to get 150 basis point over risk-free. The REAs that we talk to are rethinking portfolio construction because of this dynamic. But I want to be very clear that you don't do rate plays with this kind of product, but it can be a very stable part of a portfolio.
Yeah. Less risk right now seems to be the theme at this point, and good returns on that product. Great. Thanks for joining us, Matt. Appreciate it.